Hello and welcome to Trading 5 Talents. In this video, I am reviewing the covered call list from weeklyoptionslist.com. This is my second week covering the call list from this website. Link is down in the description if you want to check it out. So last week I went through this list. This is a new service that the developer is offering on the website. And these are the filters that I used, if you can see them down here. $5,000 limit, more than $25 in premium, 2% ROI is the minimum, and then no earnings. One other thing that I don't have on this filter set, but I do mention in previous videos about reviewing this website, and that is I'm not trading anything that is like a volatility product, anything that's leveraged, anything to do with futures, and then also I'm only choosing the first suggested strike price of a ticker, because sometimes a ticker is mentioned multiple times or suggested multiple times, and I'm only choosing the first one, so that way I can get a nice variety, a nice sampling of what is being suggested here. So let's take a look as what was suggested last week for entry this past Monday. And so you can see there are 10 of them. They're just in order. And these are the suggested strike prices for the covered call. And then, of course, the prior Friday's closing prices of both the stock and the option. If you want a copy of this spreadsheet, there's also a link in the description. And with all of my Google Sheets, all you have to do if you want to edit a copy, you don't need to request access at all. All you need to do is just go up to File and then click on Make a Copy, and then that copy is there for your using and for your editing in your Google Drive. So these tickers at these strike prices are covered call suggestions for this coming week. So these all expired this past Friday, and I'll be showing you exactly how they played out. All right, so the way that this works. So first of all of these calls, just like the put list on this website, they're all 5 DTE. So the idea is to open on Monday and then you close or let them expire by Friday. So they're all 5 days until expiration. And the idea of the covered call is you purchase 100 shares at the market open. In this case, for NNOX, it was $10.82. And then you sell a covered call at the suggested strike price of $11. Now, when you sell a call, just like selling a put, you're going to get a premium, and that's what's listed here at 45 cents. So this is 45 cents per share. There's 100 shares per contract, so that'd be $45 in profit. So you would spend $10.82 per share, so $1,082 for 100 shares. You'd sell a covered call at $11, and then you'd receive this $45 profit immediately. Now, the idea of selling a covered call is if the share closing price by expiration is above your strike price of your call, then you have to sell all 100 shares at that strike price, so $11. If the shares price is below your call strike price by expiration, then you don't have to sell your shares. You get to keep all of your shares, but in either case, you get to keep the full premium, $45. Right? So that's how all of these are. You can see, you open at 1082 and you sell an out of the money call that is above the current price call at $11. 1032, you sell out of the money at 1050. Here's one that's in the money, $29.78 the stock is, but you're selling a call that is below what you purchased at. So if this were assigned, okay, you would lose this $29.78 minus $29.50. You would lose this $28 amount right here, but you're gaining $98. So you're gaining 98, losing 28. So you're actually gaining $70 from this whole transaction if these were assigned. So let's take a look at how these played out. Monday prices, stocks on top, and then options on the bottom. So the green and red just indicate whether or not the stock is increasing or decreasing from the previous day. The premium of the option in these boxed cells are red if you are gaining in premium, which is not good for an option seller, or if you're losing premium or staying the same, which is good for an option seller. Okay, so that's what all the colors mean. So I have these spark lines in here just for easy reference, and you could see if they were assigned or not and the final ROI. Of all 10 of these, 9 of them were not assigned. Are these winners or are these losers? Again, we talked about that in last week's video. I'm not assigning winner or loser status, but the developer did mention the winner status, at least on his website, is that if you get to keep your shares. For what it's worth, that's what the win-loss means on his website. So this one was assigned, the rest were not. So let's take a look at what a non-assignment looks like. So let's just look at this second one, MJ. So you purchased at $10.32 and you gained 30-cent credit per share. Then you sold the $10.50 call. So if the stock, it's right here, if the stock closes above $10.50, you have to sell your shares at $10.50. You can see it goes from 1046 to 10 to 984 to 949, 935. It's closing below 1050. Therefore, it's not assigned. All right, so the ROI, how is that calculated? Well, because this call was out of the money, you can see the premium going down and it will eventually expire worthless. So the ROI is calculated as the premium received, 30 cents, divided by how much money you had to pay to purchase 100 shares of the stock. In this case, I'm assuming it was $10.32. So 30 cents divided by $10.32 multiplied by 100 would be a 2.9% ROI. All right, let's look at the NNOX because this was the only one that was assigned. Opened at $10.82. So you spent $1,082, and you can see the stock goes to $12.13, $13.39, $12.64, $13.06, and then finally $12.03 by Friday, which was above the $11 strike price that you were selling at. You could see that there is some value, there's some intrinsic value left in this option, but that doesn't matter when you're selling these options because you're only concerned with the premium that you received initially. So you keep this premium. So 45 cents divided by the 1082, that would have been a 4.2% ROI just with the premium though. Just with the premium, 4.2% ROI. But now you have to sell your shares at $11. So you actually purchased them at 1082. But you sold them at 11. So that means there was an 18-cent capital gain on this particular trade. So this 18 cents, 1082 to 11, plus the 45 cents, which is, you can see 63 cents. So if we took all of that and divided it by the 1082, you can see that the actual ROI should be 5.8% because when you sell covered calls, if you're selling them above your entry price, if you're selling the call at a strike price above your entry price, then you also factor in the capital gain that you are making. So this actually has a greater ROI, 5.8%. All right, so that's an advantage of selling covered calls. You gain on the premium and also the stock appreciation. So two ways you can benefit with covered calls. All right, so that's an advantage with the covered call. So what did we make? We made 18 plus 45. That was what? That was 63 cents. Okay, so we made $63 with this play. But here's a drawback that some people see with covered calls. That is, you cap your profits or you limit your profitability. For example, using this same NNOX ticker. If we purchase the shares at $10.82 and we didn't sell a covered call and we just held them, so just buy and hold, and you sold them, if you could, at this peak of closing prices, $13.39, what would that be? $13.39 minus the 1082. So that's $2.57 per share. So that would have been a $257 gain. When we sold the covered call, we only made $63. But if you just bought and held the shares, it would have been $257 potentially if you were able to catch, that top. That hindsight is 2020. We see that in this spreadsheet that it is going up, but when you're in a trade, you don't know that the stock is going to be going up. It could be going down, as most stocks did this week, which is why all of these were not assigned. So even in a down market, selling covered calls on stocks that you own can be very profitable. So each of these premiums would have been your profit if you were to, make these trades. So yes, you can gain quite a bit of profit from selling covered calls, but you also limit your profits as a compared to a buy and hold strategy. But the advantage is that a buy and hold strategy is advantageous if the stock is going up. If the stock is going down, then you have all those unrealized losses. Here with the covered calls, at least you're making money as the stocks are going down, which are indicated by these spark lines going down. Okay, the stock has been going down all week, except for that one on the top, and we're still making money. So that's the advantage of selling covered calls. That's why I like the wheel strategy. All right, there's something else I wanted to mention here, and I'm going to use this RIVN as the example, and I'm going to hide everything else to make it a little bit easier to follow. All right, here we go. RIVN, the suggested covered call price $50. It opened on a Monday at $46.24, and so we sell this out of the money $50 strike price. Okay, we get $90 in premium. The question is, or I guess the issue I wanted to address is, what do you do with this premium? Well, I mean, of course it's profit. So there's really two things you can do with this profit. One, you can just add it to your profit column, whatever you do with that, if you withdraw it and use it for paying bills, or you just keep it and increase your trading account. I guess the other option that you have in dealing with this profit is that you actually apply it to the cost basis of your stock. So what is the cost basis? Well, I do have a video on calculating your cost basis. I have an old cost basis calculator. I don't use it anymore because it's all now integrated into my current trade log. And if you'd like to know how to use that trade log, I'll leave a link in the description for both the trade log as well as a video on how to use it. But the cost basis is how much did you pay for your stock. So if we did not have any RIVN in our account, and we simply bought 100 shares of RIVN at $46.24, then our cost basis would be $46.24. So when we would sell a covered call on this, of course, we could sell this 50. It expired worthless. We were not assigned. We still have our shares at $46.24. Now, we gained $90, and what we could do is we could sell another covered call at or above our cost basis, $46.24. So we'd probably want to sell at least the $46.50 strike price or higher, right? What did it close at? Look, it closed at $38.83. So this is way below what we purchased it at. So what we then can do, if you're not going to apply this premium to your profit column or your overall profits, we can apply this premium to this particular stock, and we can lower our cost basis, or as some people call it, lower your break even. I refer to it usually as the adjusted cost basis, and that's what I have in my spreadsheet. $46.24 was our initial cost basis. We purchased them at $46.24. However, we gained a 90-cent premium per share, so we can subtract 90 cents. So really, we can say that our cost basis is $45.34. It used to be $46.24. Now it's $45.34. That is, we're taking the premium that we gained and we're applying it to our cost basis. So every time we sell a covered call, we can potentially reduce our cost basis more and more. And you can reduce it so much theoretically that you can have, basically these shares are $0. That is, you have these shares for, free essentially, or you can have a negative cost basis. That is, you're making more on your premiums than you actually paid for the stock itself. So those are two choices that you can do when you gain these premiums in covered calls, or I guess any premiums. You can either apply it to your overall profit, which is what I normally do, or you can take these premiums to lower your cost basis. And when you do so, now you can start selling covered calls at your new adjusted cost basis or break even or higher. So instead of having to sell a covered call at $46.50 or higher, at or above your cost basis, now that your cost basis is down here at 45, now you can sell covered calls at $45.50 or higher. And you're going to have better premiums down here closer to the current trading price of this particular stock. However, what you can't do is you can't doubly apply your premium. If you're going to take your $90 and put it in your overall profit and loss column, you can't also apply it to your cost basis, because now you're, sort of double dipping into this profit. It only can go, one of two places: your profit or lowering your investment cost basis. So the reason I bring it up is because later on, I'm going to be making a video, I'm not exactly sure when, of how I'm doing this to lower a cost basis of certain shares that I own for a very specific reason. Not necessarily just to see how low I can get the cost basis, but I have a very specific reason for lowering the cost basis, or my cost basis. So if you have any questions about cost basis or covered calls, or some of the plays that I highlighted this week, then go ahead and leave a comment down below, or catch me on Twitter at Trading5Talents. If you like this content and you want to keep up to date with all of these reviews of both theweeklyoptionlist.com as well as optionseller.com, then go ahead and click on the subscribe button and turn on the notifications so you can catch all the updates. Until next time, trade wisely and take care.